Hello, my name is Rob Newman. I am one of the partners at Carter, Collins & Meyer, and I'd like to thank you so much for watching this short video. Today's subject is, my company is profitable and yet you're telling me I'm insolvent. How can that be? Well, this is a subject that happens a lot to small businesses. This is one of those things that catches people out. They've been trading, they've been working hard in their business on a day-to-day basis, and suddenly they can't pay the bills. They can't find a way to meet that tax that they've got, or they can't pay themselves, which is even worse in many respects. So today I'm going to look at the difference between profit, cash flow. There's an old saying in accountancy: turnover is vanity, profit is sanity, and cash flow is reality. Now, this video is very much about that. There is a difference between profit, cash, and assets. And many small businesses will have one of those factors but won't have all of them in place. And suddenly they find themselves being pushed into an insolvency situation. Now, 5 years ago during the pandemic, HMRC took a really soft stance with insolvency and they almost dried up. And my friend, the insolvency practitioner, had one of the worst couple of years he'd ever had during that time frame. But now most insolvencies are being driven again by HMRC. HMRC have preference in insolvency. If you go bust, they're the first people that can claim anything that's there. And increasingly what they're trying to do is to claim some form of director misfeasance or misaction. Once upon a time, they'd try and go after a wrongful trading. That's really hard to try and get those things through. But misfeasance is something that is increasingly being seen within the insolvency world. Now, I should make this clear. I'm not an insolvency practitioner, but I do a lot of pre-insolvency work, and I do have a lot of small business clients within Greater Manchester, Lancashire and Cheshire. And unfortunately, I have seen this process a lot over the years with them. So I'm very familiar with how this works. And yes, you should speak to a licensed insolvency practitioner if you're in that situation. But before you get there, do reach out to your accountant, because some of the simple things that I'm going to talk of today can have a huge impact on your business and can actually save that process or do a pre-insolvency procedure. It may not even be a formal one that will allow you to come out at the other side. Now, although I say a lot of insolvencies are driven by HMRC in the last couple of years, my own personal experience as a business owner myself and working with lots of clients is that if you speak to them, if you make it clear where your situation is, you can usually get a deal. There's usually something to be there. And only in the last 6 weeks, I've managed to get a time to pay arrangement for a client who owed nearly £500,000 in total taxes, spread over a 60-month period with no interest or penalties on it. Now, there was quite a bit of work in that, and yes, there was costs and fees involved. But to get that type of lifeline for a business, which is fundamentally sound, but had hit those kind of differences between profit and cash, is significant for him, because he had personal guarantees in place, as do lots of small business owners. Because it's very rare nowadays that any form of finance will be available to a small business without giving that personal guarantee. Which means if his company had gone bust and had gone into a liquidation, that personal guarantee would have been called, and he was probably facing losing his house as well. So, what causes this difference between cash, profit and assets? Well, most small business owners who are not accountants think of it in terms of what's passed through the bank. But that's not how accounts are prepared. Accounts are prepared on what's called the accruals basis. You look at when things happened and what's coming out the other side to it. One of the most significant ones of these is stock. You may have paid out for the stock. You may have actually physically put the cash out there to your supplier, but it's still sat in a warehouse. Now, that stock is not an expense to you from an accounting point until you actually sell it. Whilst it's sat in the warehouse, it's an asset. And whilst it's an asset, it doesn't hit your profit and loss account. So you might have only had £100,000 of cash come in, but you might have used all of that £100,000 to buy stock. If no other transactions had happened in that year, you've made £100,000 profit, even though you've got no cash whatsoever. So when HMRC turn around and say, well, can we have our £20,000 please in corporation tax? you can't meet it. You've got a load of stuff there that you can sell, but you haven't sold it. The next stage from that is you do have the stock, you do sell it. It turns into a debtor, but the person hasn't paid you. So your customer owes you money. It's now a profit. So taking that original 100K, it might now be that you've got transactions of 150K. You've got 50K of debtor, money that's owed to you, and £75,000 of stock. You've made £125,000 profit. HMRC are saying, can we have 30K please? But you actually haven't got any cash. And that is what catches most small business. Accountants call that overtrading, where the cash pattern doesn't match what's going on around it. It's so easy, particularly in growth stages, particularly if you are catching up on things, to end up in overtrading. And when you do, it's so common for small businesses to have that cash flow squeeze. Now, a lot of them cope by using the VAT money or the PAYE money. And that creates its own problems, because from an insolvency point of view, if you use money that actually belongs to HMRC to cover your day-to-day and end up with a bigger debt to HMRC, you slip into director misfeasance. Director misfeasance being the problem that gets you out of having limited liability and being personally responsible for things. So what can you do to change some of this? Well, one of the most obvious ones is watch everything that's going on in your company. And when I say watch everything that's going on in your company, not just that bank balance. Yes, I know I'm an accountant. I want you to do accountancy, but it's not just the accounts. Accounts are fundamentally useful to small businesses. And you really do need to get the language of what accounts means, which is what some of these videos are going to be over the next couple of years. I'm going to show you how to look at sets of accounts and what they actually mean. Not just the pretty year-end statutory ones, but actual underlying things. But it's then, what is the story of that telling you? If you've got loads of assets building up, stock, debtors onto things, but you've not got the cash coming through, there's practical stuff you need to do. You need to get on the phone. You need to get on the phone and ring those customers that owe you money and say to them, when are you paying? When's it coming through? It's horrible. Nobody likes ringing customers for money. Of course they don't. But if you don't do that, you're the one that's going to suffer. You may then need to progress that onto, debt collectors or solicitors or whatever else comes from those processes. But half the time, just that little bit of pressure that's necessary to collect it through makes that difference. The other thing you've got to do is look at that stock that's on the shelves. Look at that thing there. If it's not shifting, if it's not moving, you've got to come up with ways to make it move, because that cash blood life flow through the business is worth far more than the stock value is, even if you are not making the profit on it that you thought you were. Dead stock is going to cost you far more in the future. And all of the things within your business are like that. If you've got stuff sitting there that's not doing anything, that's not moving, that's not changing, you've got to look at it, you've got to consider it, and you've got to try and move it on. Because that's how small businesses that are profitable on paper and the accountant are saying doing really well, suddenly end up as insolvent. They have circumstances, situations, things, assets usually, in the accountant's phrases, that just don't do anything, that just don't become anything. And before they know it, it's caught up and I'm walking them into the insolvency practitioners. Now, there's lots we could talk about in this area, but you've now listened to me for nearly 10 minutes, and I thank you so much for that. My name's Rob Newman, I'm from Carter Collins and Meyer, and if you found this video useful, please do reach out or drop a comment below.